Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Tuesday. It's August 23rd. Before I begin, just want to let you guys know my email address is support@marketgeeks.com. And if you guys are enjoying these videos, send me an email, post a comment. Let me know. I want to hear back from you. I want to know if I'm helping you survive during these tumultuous and nutty times in the market. Now, let's get into today's video. So today's August 23rd. The market's going to open up in about an hour and 29 minutes to be specific with you. And the market is a little bit higher, but 9 points on the NASDAQ and 33 points on the Dow doesn't really make up for 600-700 point downslide that we had yesterday. I mean, it was a nutty volatility. Let me show you what I'm talking about. And if you think we didn't expect this, we did. Here's where we're at right now, and this is what we did yesterday, and this is where we're at right now. So I'm still pretty bearish. If you look at the SPY, you will see that we keyed off right off of that 200-day moving average as I predicted. I told you this was going to happen, and it did. And now we're coming down, and I think we're actually going to come down quite a bit more because momentum levels have not done falling. And if you look at QQQ, you've got exactly the same situation right here. And if you look at the Russell, which we will right now, you've got exactly the same situation. Everything bouncing off the 200-day moving average. But I think we're going to go into this area. I think we're going to go into this zone and reverse probably 70% of what we gained over the last month. And the reason I say that is because of momentum levels. Look at consumer discretionary. Look at the number of stocks trading above the 50-day moving average, 79, 16. Really, you think this is going to sustain itself? Or communication services, 54 to 15? These numbers have to start looking a little bit more like this. Notice we still have a lot of safety and foundational growth in consumer staples, energies, and utilities. And by the way, as I go through this, just so you know, top sectors right now, utilities, energy, industrial. Notice consumer discretionary starting to come down. Consumer staples is going up because if you look on a monthly basis, you got consumer discretionary here and consumer staples down here. It's all moving back. Markets get fragmented on the way up and they get defragmented or stabilized on the way down. Now, in terms of data today, you've got PMI composite flash, not a huge report, but you have new home sales. This is going to be very interesting because investors are thinking that if economy starts really slowing down and interest rates are going to go up, new home sales are going to decline substantially. The number has been they've been holding on a little better than expected. We're looking at new home sales, 575 is the estimate, right in between the range. I'm hoping the number is near the 610. Last time they were revised sharply. So we'll see. We'll see what the new home sales numbers look like. It'll be very, very interesting to see how many new homes are sold. If the number's going down, it would make some degree of sense. Tomorrow we have a big report, durable good orders. This is huge to see if the supply chain is still impacting us and how China's doing. And we've got GDP on Thursday. Don't make too many bets before the GDP because that can have a real impact on the economy. And then we've got a lot of reports, plus Mr. Jerome Powell speaking. Now, yesterday, we had Palo Alto and Zoom. I want to show you this. Look at Zoom. Palo Alto is doing really good. It's up 10%. Orders are coming in. Numbers are solid. I like this pattern. I like how it has a consolidation and it's now breaking above the 200-day moving average. This gap will probably get filled, but this is a very, very good news. On Zillow, now Zillow is not what we're looking at. Zoom is what we're looking at. What am I doing here? I'm going crazy here with these ticker symbols. So Zoom is down quite a bit. Look at this. It's down 11%. So Zoom didn't do good, and they didn't give good forward-looking statements. Now, today, we've got Advanced Auto Parts. We've got Dick's. This is going to be big. Remember, retail. This is a big week for retail. Intuit, one of my favorite stocks, one of my favorite consumer staple stocks, Chinese stocks. You've got Nordstrom's and Macy's and Toll Brothers and Urban Outfitters. Now, a lot of retailers. Now, according to Macy's lowers outlook despite strong second quarter. So they didn't do bad. They earned $275 million, 99 cents a share. They were expecting, let's see here, I wish they would just tell you right away. Well, we could find out here what they were expecting. Macy's 88 cents and they got 99 cents. So they did better than expected. But again, forward-looking lowers outlook. That's what we want to look at right now. The forwarding outlook is the big key. Now let's talk about global economy. Investors are grappling with uncertainty over with the highest U.S. inflation in decades will ease significantly and how much U.S. Fed will raise interest rates in order to get it under control and in what time frame. Remember, it's just a balancing act. China, People's Bank of China cut lending rate Monday, a week after it's cut interest rates. They're doing everything to stimulate their economy, and they're talking very differently than they were talking a year ago or 2 years ago about how they were going to break down the public companies. They're really concerned right now because remember, they're the biggest exporter in the world and the second biggest economy. The broad market's losses come on the heels of a week-long rally. Investors are trying to figure out where the economy goes from here as stubbornly hot inflation hurts businesses and consumers. Minutes last week from the Federal Reserve's July board meeting affirmed plans for more rate hikes. As long as consumers are spending, and it looks like they are, we're going to have more rate hikes. But I think we are, in fact, getting this aggressive inflation under control without tipping it into a recession. Federal Chair Mr. Jerome Powell, I'm not going to give you bad news till I'm going to get reelected. Yeah, I said it. He's scheduled to give a speech on Friday at the central bank's annual meeting after the GDP comes out. The Fed is holding its meeting following a heavy week of company and economic data showing inflation is still squeezing economy. And crude oil is finally moving higher, but consumers are spending. That's really the big factor. I'm very interested in how the market will move, but most importantly, I'm focused on the bond market and whether the bond market is going to break new lows. Now, if the bond market can stay in this range, it'll give some stability to the stock market. If we start seeing the bond market breaking lower, that means interest rates are substantially going higher. And if interest rates are substantially going higher, it's going to put even more pressure on tech stocks than they were already seeing around here. I kind of wish I sold more of it aggressively around here, but I didn't. But there's always opportunity. Again, I'm only going with the trend, which is a downtrend, which means I'm only selling to the downside. So in terms of the bond market going back down, that puts more pressure on speculative stocks and puts less pressure on defensive stocks like utilities, energy, industrial, maybe a little bit of consumer staples in there. And again, if you look at my sectors, you'll see utilities started to cooling off a little bit. Energy still strong. I like energy. Industrial's coming off, just like I told you that industrial, consumer discretionary. Industrial's not really that defensive now that I think about it. Industrial, consumer discretionary, and technology. Those are the biggest losers. I think consumer staples is going to be able to hold on to this trend. I think energy is building a nice trend. Where is? I think basic materials will do okay. But look at communication services. I want to show you something. XLC. It's already breaking that uptrend that we had. Already breaking that uptrend. Let me show you what I'm talking about. Yeah, if you look at communication services, you'll see that uptrend that we were getting on a 3-month, let me show you. It's already being broken. It's already being broken. So it looks like we're going to go down to this base, as I predicted several weeks ago. Let me just show you something here. Yeah, see this communication services? It looks like it's breaking this uptrend, and it's going to go back down here, which is exactly the fate that I'm expecting for consumer discretionary, technology, and industrial. I am liking utilities. I am liking energy. I am liking consumer staples, and I'm liking healthcare. I know we're going down, but the market was down like 700 points yesterday. I think we'll see a little bit more upside, but overall, I think the market is in a downtrend right now. And that is something that momentum levels have been telling me. Now, we still have 79% on the broad market and 79% on consumer discretionary. Folks, I can't say I'm 100% certain, but I'm almost certain that these levels are going to be coming down. Look at the consumer discretionary sector. I mean, look at this. This is too much too fast. It can't sustain this. It's going to cool off, and it's going to bring tech and other goodies with it. Now, today's Tuesday. What do I talk about Tuesday? The strongest sector, strongest stock, weakest sector, weakest stock. So that's going to be very easy right now, because if you look at the S&P 500, you will see that energies are leading again. Defensive stocks are leading again. You could take your pick here, but in my opinion, in my humble opinion, I like Enphase right here. I like defensive stuff. Where is it here? I like Oxy, Enphase. I like the energies again. And I like Quanta. We went long this stock yesterday. I like Quanta. So I like utilities and energies right now. Enphase, I think that's a utility. It's a great company. Petroleum, I like the meat and potatoes. Now, let's talk about the worst stock. Are you going to be surprised when I we've been at this forever. Yes, folks, Royal Caribbean's, Dish, yes, Dish, Norwegian. Now, if you watch my video from a year ago, it's the same, nothing changed. Expedia, Gap, Charles River Laboratories, but the bottom line is Target, Bed Bath & Beyond, Dish, Royal Caribbean, Norwegian, Expedia. Nothing has changed. Nothing has changed. These are still the worst stocks, and ultimately, I think consumer discretionary is going to be coming down. So I think you need to focus more on the defensive stocks. And if you look at the S&P 500, I want to show you this. This is interesting. Look at this. Here are the sectors. Look at energy, consumer staples. This is yesterday. It says today, but let's look at it on a 5-day. Energy, consumer staples, utilities. It doesn't lie. On a 1 month, energy, utilities, industrial, look at consumer discretionary and tech. But on a 5-day, no more. So I think what we're seeing here is going to be controlling for the next foreseeable future. Energy, consumer staples, utilities, and healthcare too. And on the downside, consumer discretionary, information technology, and communication services. I see the next couple of weeks play out exactly like this. I think if you were to copy this and take a roadmap, you would have a really good idea of where the markets are going right now. Now, I'm getting very excited about something. Joy of the trade, Jeff Zananeri, folks, he's been working on a brand new way to trade. This is brand new. He's never done this before. He's done this before, but he's never shown you guys how to do it. He's done this many, many times before. And in doing so, he's found something I think you're going to find very, very interesting. When I heard Jeff is doing this, I loved it. I absolutely loved this. I'm actually a little jealous, if you want to know the truth, because I kind of wish I thought of this myself. It's got to do with big banks and their timing for upgrading and downgrading certain stocks. Now, Jeff spent nearly 2 decades on Wall Street, and in all of his years trading, he's never seen anything like this. He's revealing all the details of what he's found and how he's going to trade it in a special workshop. Meat and potatoes, no fluff, no monkey business, no bananas in the tailpipe, all real trading goodies. It's happening today at 1 p.m. Eastern Time. Click on the link below. Get the details. Sign up for the free workshop. Do it now. I mean it. Do it now. You're going to want to see this. This is really, really cool stuff. And remember, defensive stocks are coming back and offensive speculative stocks are going down. We're going back to how we were first part of this year. I'd love to tell you otherwise, but it is what it is. And if you like these videos, comment, feedback. You'll find the link to Jeff's workshop in the YouTube channel below this video, in the descriptor, or if you're watching on the Wealth Press page, it'll be right below this video. You don't want to miss this. This is a world premiere. This is going to be very, very cool. I would hate to have you miss out. Bye, guys. I'll see you later. Comment if you like this video.